How do you value a startup? I'm sure some of you on this call have an MBA. And I know because I taught MBAs that in the finance class, they teach you a bunch of ways to value a company. They teach you the discounted cash flow model. They teach you what internal rate of return is and how to compute it. They may teach you how to do comparables, which is kind of like how homes are valued. You go and find a bunch of homes that are kind of like that one, and you see, what did they sell for, and you know, change the value slightly based on the number of bathrooms and the quality of the kitchen appliances and whatnot. And the punchline is none of those are useful for valuing a startup. Strangely enough, none of that math, none of the financial models looking forward, nothing that they're presenting to you in terms of a business plan has anything to do with the valuation of the company. And that sounds really weird. Ultimately, it comes down to pie charts. So what percentage of the company are you going to buy as an angel group, as an angel group, or a small venture capital fund? What percentage are they selling you and what percentage are they keeping? That's what the valuation is based on. And I'm going to give you an anecdote to explain that. So it was 2005. It was my fourth startup. 2005 was a milestone in the age of startup. Oh, sorry, 2004. You're right. Yeah, sorry, 2004. All right, let me do that one again. I'm getting old. So here's the anecdote. It was 2004. And 2004 was a giant milestone in the age of startups that unless you were as a founder in those years, you just didn't notice. So there was this thing that you did all notice in 2000. It was called the dot-com bubble, or the end of the dot-com bubble. And that bubble burst in March of 2000. And the market went down from there, and it kept going down all the way into 2001. And what happened to the venture capitalists and the startups, the venture capitalists saw this happening, and they had an enormous amount of losses on their balance sheets. Right? All these dot-coms that they had invested in were worthless or near worthless. They were trying for like 2 years to keep them around, hoping that the bubble would reinflate. But bubbles don't do that. And so they weren't investing in new companies. There were like no new checks to startups in 2001, 2002, 2003, and the first half of 2004. And what changed it, the thing that happened in 2004 that woke up VCs and said it's time to write checks again is the clock, because they're 10-year funds and they have to write checks eventually. But really what did it was the Google went public in April of 2004. And so it was a pretty big IPO. It was $85 a share, which a lot of us thought was just ridiculously overpriced. Kick me now. But Google was 4, 5, 6 years old by then. It was a huge success, and it woke up the VCs because they got to see, oh my God, this IPO thing still works, right? Tech companies can still make money. So they started writing checks again. So I wrote a business plan in June of 2004. I did it at a acquaintance's house here on Bainbridge Island in the backyard. And 4 of us were the co-founders of this company. So 4 of us got together and decided to start this company. It's called Media Systems, name we threw together. It was mobile search. 3 of us knew each other. We grabbed one more person. He was there in Stanford with Sergey and Larry when they started Google. He was a PhD candidate as well. He was there at Stanford when Jerry Yang started Yahoo. He had class together with Jerry. He had missed out on search, but he wasn't going to miss out on mobile search. So we had 4 of us. We had all been funded by VCs before in our startups. And this one person who had been there at Stanford, not only did he have that going for him, but he was an entrepreneur in residence, EIR, entrepreneur in residence at a top 10 VC fund in Silicon Valley on Sand Hill Road. So his job, they were paying him a salary to go find something to fund. So they were all primed to make this investment. And in we walk, 4 of us, we fly down to California, we drive over to Sand Hill Road, we go to the office, we're meeting with the partner, which is what you do to start these conversations. We meet with one partner and we pitched him the company on PowerPoint. We really had nothing. We had no product, but it was just 4 guys who had been funded before. And the VC turned to us and he said, all right, I'll give you one-on-one. And so I'm going to tell you what that means. So one-on-one, that's the jargon that VCs use. It's really short and sweet. So one-on-one means that he's offering us $1 million in cash. The first one means $1 million in cash. And on means that he's valuing the money pre-money, before the cash, as $1 million. So I'll say that again. So he's offering us $1 million in cash, and he's valuing a company that's just 4 people in a PowerPoint at $1 million. And we had one conversation with a customer. I think, in fact, my partners had flown to see this customer by then, but we didn't have any signed deals. We had no revenues. We had no customers. We had no product. Basically, he was offering us a company worth $2 million. He was going to provide half. And so we turned to each other, and it literally in 20 seconds, we just looked at this one EIR partner of ours who was our negotiator for the day, not our CEO of the company at the time, but our negotiator. He later became the CEO. We looked at him and we just all shrugged and shook our heads a little bit and said, that's crazy. And so what did the VC do? And so this is one thing you need to understand, or really entrepreneurs need to understand. One thing that's fun to understand about venture capitalists is that it's a partnership. That if you're talking to a partner, they have a lot of rights. They have the right to negotiate with you. They don't have to go back to their partners. It's not like buying a car. They don't have to go talk to their manager. They don't have a manager. They're a full-on partner in this company. They can make a deal whenever they want, and then they have to go sell it to their partnership later. They still have to get approval, but they can negotiate on the fly. So he said one-on-one. We literally looked at our partner, our guy, our co-founder, and shook our heads. And he just said, no, come on, that's crazy. And so the VC said, all right, 2 on 2. And so I'll just parse that again. That's $2 million on a $2 million pre-money valuation, or $4 million valuation of this company, which, just be clear, it was 20 seconds older. Still didn't have a product or a customer. It was only 20 seconds older than one-on-one. And so this is where those of you who have an MBA or know what a discounted cash flow model is, or internal rate of return, should be going, I don't get it. How did the company grow its value in $2 million on the word no? Well, it gets fun, because we then turned back to our co-founder and gave him basically the same gesture again. And he said, no, come on, be reasonable. And so the partner said 3 on 3. And at 3 on 3, we said, we have to talk. Can you leave your office? And the 4 of us had a little powwow for, I don't know, 2 or 3 minutes. Because we were now talking about a company that was worth $6 million. A company with no product, no customers, could have $3 million in the bank right now. Like, we know the partners were going to say yes to this because we had an EIR on our team. It wasn't like we were just walking in off the street and hoping everything would go well. We had an insider on our team who worked for the VC and knew all the partners, because he worked for this one partner, but when you're an EIR, all the partners know you. And so we could have walked out of that door that day with $3 million. And it would have taken, 2 weeks, because there wasn't anything to do due diligence on. We were known entities. We had nothing to check. There was barely a legal structure to check. And so we talked about this for, I don't know, 2 or 3 minutes. And ultimately we said no. We said no because we were being offered half of a company. And that was the first round. And so we didn't really know how much money we would need. We knew we would need more than $3 million to build this company. We didn't know how much more, but we did know that the offer on the table was half the company for the cash. And that felt wrong. That just felt like it was too much. And so the value of the company wasn't so much 2 million, 4 million, 6 million as 50%. Right? We were splitting the pie in half, and none of us as co-founders, as entrepreneurs, could live with that. And so we said no. And what we got instead was $750,000 in a convertible note to the next round. And the next round wound up being $7 million. No, sorry, we raised $7 million on, I have to do the math in my head, where they bought about 42% of the company. So we wound up selling an even bigger pie, a smaller slice of a bigger pie, and it made the company worth a lot more by not taking this deal. Now, that was the normal deal in 2005. Here we are, here we are in the middle of a pandemic. No, there is no deal to be made right now. But what it was, 5 months ago in January or December of 2019, was the norm. It had moved all the way to the fact where that same amount of money, that same startup, if we were able to go do that same startup right now, we would have been talking about selling 25% of the company to the venture capitalists. That's a pretty normal deal these days, or to an angel group. When you raise money in 2019, you would sell 20, 22, 25, maybe 28% of your company, not 50. 50 was the highest it ever went. 50 was crazy. Not a whole lot of deals happened at 50. So if it had changed, if it wasn't 2004 when we walked in that door, if it was 2019 and we went and tried to do that deal and everything else was the same, he would have said 3 on 9, right? So 3 on 9 means here's $3 million in cash. We're calling the value of your company without the cash, pre-money again, $9 million. And so the total company's worth 12. And so, 3 divided by 12 is 25%. The investors are buying 3 divided by the post money, or the dollars divided by the post money. And so that would have been a 25% deal. That we would have said yes to. If he had said 3 on 4, we would have said yes to it. If he had said 3 on 5, we tried that. And when he came back in the room, we said, just make it 3 on 4 and we got a deal. And he said, no, I can't do that. We said, make it 2 on 3. We'll do that deal. And he said, I can't do that either. So he was stuck on 50%, and we were stuck on not 50%. And so we couldn't do a deal on a valuation in that day. And so again, here's how that math works. So if it was 3 on 9, the total pie is worth 12, right? 3 is the small piece that the investor's buying. 9 is the piece that the other shareholders own. So if we're going to do this math, you should be able to do this math in your head if you're an experienced angel or VC. So if the price of money is 25%, this is the other way to think of it, is what does money go for right now? Which is a really weird concept if you've never thought about it this way. Money has a price to it, and it's priced in percentage of the pie. That's the easiest way to describe it. So in the end of 2019, in the major cities in the US, the price of money was 25% of the company. And so that would be 3 on 9 or 2 on 6 or 1 on 3. Those are all buying 25% of the company. The value of the company, whether it's 4, 8, or 12, simply depends on how much money the company needs. So if they give you a plan that needs $1 million and the price of money is 25%, you as an investor would say, great, we'll do 1 on 3. Right? We'll do a post money of 4, you might say. You might say we do pre-money of 3. Right? As you keep seeing in these examples, pre-money is the number that gets batted around the most. So if the company needs $2 million, you would value it at 6. And if the company needed 3, you would value it at 9. The value of the company has to do with how much money they need and the value of the money, not based on their sales, not based on their traction, not based on the team, not based on anything else. And whether it's 25% or 50 depends on the market conditions. That's the price of money as it changes now. I'll show you that in a bit. Which is just a really weird result. When I show this to entrepreneurs, they don't get it. They don't understand. Well, why is my value of my company so low? And I said, well, you just can't put enough money to work. Right? If you could put twice as much money to work, your value of your company would go up. And they have a hard time figuring that part out. What this also means from the angel investing side is be wary of how much money they're asking for. And you can do this in hundreds of thousands too. If they're asking for $200,000 and the price of money is 25%, then they're worth $600,000 with a post of $800,000. They might think, if they're in Seattle, they might think, well, that's crazy. Anything below $1 million is just unreasonable. This company has to have at least $1 million of value. And you can show them this math and say, that's nice, but if you want $1 million of value, you got to raise at least 200 and something thousand dollars. Like, I need my 25% of the company. And so let's do a little exercise. Can anybody do this one in their head or figure it out on a calculator? So if we're doing 3 on N, where you're going to buy 33% of the company, what's N? And then what's M if it's 2 on? And then it's what is Q if it's 1 on this number? So 3 on what, 2 on what, and 1 on what gives you 33%?
Just double the number.
Think so?
2 on 4, 1 on 2. Is that how it works?
So great. Yes, that is the answer here. So in this particular case, it's easy because you can double the number, because if you got 1 piece and 2 pieces, that's 3 pieces, right? So 3 on 6, 2 on 4, 1 on 3. 33% was the value of money between 2005 and until the big panic in 2007. So that was a really common number that the VCs would ask for, the angel groups would ask for. And then once we got through the recovery, again, recovery happened and raising money was hard. Not as hard as the dot-com bubble, but still hard. And so once we got through most of the recovery, this number just kept going down and down and down. There was more and more money being thrown into venture capital and startups. And so the value of the money went down from 33% to 30% to something between 25 and 30% to 25%. And in fact, if we were in San Francisco in 2019 and we were talking about startups, we'd probably be lucky if we got 20% of the company, if we were buying the same piece of the same company that was based in Seattle. All right, can anybody do 40-60?
You divide by 2 and times by 3. How you do?
Yeah, so we get 3 on 5, 2 on 3 and a third, 1 on a 1 and 2/3. So I think I made a chart here. So here's your cheat sheet. You can come back to this if you're trying to figure this out. There's lots of ways to do this. Most of the time, people just kind of add the two numbers together and then look to see if they got the right percentage, and if not, try again. Usually it's trial and error until you memorize the tricks here. And these are the usual 3 milestones. And we'll probably be at 40%, when we get through the pandemic. By the end of the year, beginning of next year, the value of money might be as high as 40%. I don't think it's going to 50 again. Or it might be 33%. It's not going to be 25 anymore. And so the value of the money will have gone back up. And so we're going to see a lot of deals where it's, a few $100,000 on a few $100,000, or a 1 on 2 and 2 on 4s and so forth. And that's just for the seed stage. I want to make it clear. I'm just about done here. That valuation is based on the early stage companies. If you remember that chart I use that shows the valley of death. Once you get past the valley of death into the growth stage, well, then the percentage ownership that you can get for your capital goes down, because the risk is down, because the expected increase in value between the time you invest and the time that there might be an exit goes down. And so it doesn't really change in the seed and startup phase, which is another weird anomaly. So everybody's expecting just 10x, whether they're investing very, very first in Series Seed or very, very first in Series A. They're probably going to get about the same results. It's going to be 2.5 times their money in the portfolio, or 10x on a good deal. And then once the company is 3-4 years old, earning revenues where the expectation is maybe 5 times growth, then you got to take down these percentages down a bit, right? So instead of maybe 33%, then they'll get 25, and the next round will get 20, and the next round will get 15, and so forth. And once they get to be the huge stage, right, when it gets to be like Zoom right now, or just before this pandemic hit and Zoom took off, and they were growing pretty fast, well, those investors are not going to get a 10x return, or didn't think they were going to get a 10x return. Now they are. They thought they were going to get a much smaller return before that company went public. Actually, I think it did go public. So let's do this one. Before Zoom went public, a year before Zoom went public, those investors thought, okay, I have a year or 2 before this company goes public. There's maybe 2 or 3 or 4 times increase in value before it goes public, right? With a little pop in that, with some of that or a lot of that being the difference in valuation between a private company and a public company. And so when I put in at that point, $100 million, I'm not expecting to get 25% of the company for $100 million or 20. I might be buying 5 or 6 or 7 or 10% at most, right? And then there's this one stage that I put in here called mature. I put in this, it used to be called mezzanine funding. So back before the dot-com bubble, there were funders that existed that expected their money. They'd invest in private companies that were about to file their paperwork to go public with an expectation that they would be out of the company within 9 months. And so their expectation was a 25% return in total. And so a much lower return, and so much smaller percent company ownership to get that return.